Chris was president and lead analyst at Tier 4 Research, a research boutique founded in 2000 that offered high-level research to investors and industry executives. Earlier in his career, Chris was a founding partner of Cleveland Research Company and Longbow Research, holding senior analyst positions covering the metals and mining group. Chris's market presentation and outlook at last fall's ITA, now looking back a year later, has proven to be extremely accurate. Known for his industry surveys and collaboration, we are in a treat as we listen to Chris bring his style of accuracy, efficiency, and humor. So please join me in welcoming Mr. Chris Ohlin.
Hey, good afternoon, everybody. My intro is way more impressive than I am, so I apologize for that now. But what I want to do is just give you a little bit of a perspective from my company. And basically, we do bottoms-up fundamental research. So we combine this macro analysis with channel work. And we have something like 60 companies in our survey network that provide us information that helps piece together almost like a mosaic piece, the information. So part of this presentation will be kind of our views on the macro outlook for military and defense, and then we'll kind of tie that into where we think the titanium market is today, and then I'll end it with what I did last week, some ad hoc questions from our survey network in terms of some of the top of mind questions that might be out there. And for people that were watching on video, I want to remind you that the camera adds 45 pounds to the body. Alex looks great, but it's a little distorted. So let's start here, see if I can figure this out. So basically, we think the military and defense outlook is one of the bright spots for the titanium industry within kind of a weak backdrop, and you guys get that set up from the presenters this morning. We think it's a spot where not only are you going to see good demand, but potentially more supply chasing after the business that could be. Basically, our channel checks have been today revealing a surprising level of demand weakness throughout the titanium market. And it's really based on a couple of things that were mentioned earlier, but inventory. There seems to be a tremendous amount of inventory in the channel, probably even more invisible inventory than some companies are aware of. You've got some slowing on industrial related markets. Energy, power gen don't seem to be hitting targets that we thought would happen. And then you've got what looks like a conservative procurement environment related to either tariff uncertainty or concerns about the economy. But with all that being said, what we try to do is measure sentiment. And the sentiment in the channel for titanium is at a 3-year low. And I'll show you a chart on that. But within the kind of weak environment, the defense numbers have been pretty strong over the past 2 years. If anything, they've been stable. Like I said, a source of kind of brightness in the channel, and it's both on the growth from OEM demand as well as pretty strong aftermarket military demand. So, as I said, we think companies are going to be driving, or most of the expectation of driving on the strong outlook and better visibility. At least the next 12 to 18 months looks very strong for the group. The Department of Defense probably adds another layer of bullishness to the outlook. You've got a defense spending bill that could be up in the neighborhood of 12% for fiscal 2026 versus the 25 numbers. And on top of that, you're getting a lot of support from foreign defense spending initiatives. And then in terms of our forecast for titanium shipments to the military and defense channel, we're looking for something in the neighborhood of high single-digit growth year over year, at least for both 2026 and 2027. We think demand can rise in the neighborhood of 25 to 30% from the 24 levels to what we think would be the peak environment. So first off, this is one of the survey charts that we highlight, and it's basically what we gauge as sentiment in the channel. So contacts will give us their score on a scale of 1 to 10, how they feel about certain issues, titanium market, aerospace, the US economy. And the black dotted line, hopefully you guys can see, is the sentiment on titanium. So it's been steadily falling for quite a extended period of time, and it's hitting that 3-year low, as I said. And usually what this means is it will result in less incentive to make acquisitions in the market, less incentive to build inventory, hold excess inventory, almost like a de-risking gauge when we get to this type of level. And you can compare that titanium sentiment to the gray line, which would be the economy, and then the green/red line, which would be commercial aerospace. So despite the better visibility coming from Boeing and Airbus, the sentiment continues to fall. And I think it's kind of what we see as the mismatch between supply and demand. It's a little bit of a closer look at the sentiment numbers. Titanium, as I said, falling, but it's falling in a lot of other metal categories as well. The red line would be the nickel-based alloys group, and that's a market that you would think would be very strong given kind of the aftermarket demand and jet engine demand trends, but it's been falling as well. So it says that there's a lot of uncertainty related to the economic situation. So this is the monthly growth in titanium shipments for the entire channel. So it's volume comps year over year, and you can see that it's gone negative. So we're actually, we believe, in a period of contraction here, likely triggered by Boeing cutting inventories across the board, but also this kind of underlying theme where contacts or companies will say that we're only seeing orders to replace holes in inventory, nothing else today. And you might see that for the end of the year. But where it becomes interesting is you can also see there was a drop. Here, this is where I was at the last ITA show when we started to see the negative first building of inventory, and then you started seeing the negative implications from the Boeing strike last year. So from our gauge, we think there's about 18 months of inventory in the channel. So it's about 3 quarters too many. So we are concerned from a broader perspective that it could be not until something like the summer of 2026 before demand really starts to pick back up again. Okay, so this is kind of where we are. I've been doing this survey for longer than I care to admit. This is the growth trends since 2015. You can see we're at the second kind of period of a cyclical downturn, if you will. But the market is far from the spike that we saw in the Russia invasion of Ukraine time period, where I think there was a lot of procurement exuberance. People were making double, triple orders. And there's a lot of inventory built in the channel from that period that still needs to be worked down in all forms, forgings, fabricated parts, everything. So here is the military order trends from the survey, and this is the OEM business. And you can see the growth in military activity has been fairly stable. It's like 6, 7, 8%. It's been steady in that trend. No reason for it to slow down here based on the macro indicators. So definitely an outperformance. If I would show you the other charts, they would all be quite negative, especially some of the aerospace charts that we work on. And then from a bigger perspective, this is the macro 15-year outlook, or not, since 2015, I should say, the cycle. And there has not been a period of negative growth since prior to President Trump being elected the first time around. So we're still at one of the better almost like super for military and defense-related demand in the specialty materials categories. This would be military MRO. This is the aftermarket, kind of supporting that. Also an area of pretty good activity. And then if I would have showed you space and defense, it's a pretty small market. That's growing in something like a 12 to 13% growth clip. So all the arrows are pointing green for military in the channel. And like I said, we think they're going to continue to get better. Those reasons being, first, for the U.S. Department of Defense, the spending outlook, like I said, was pretty bullish. If you look at 2025, this fiscal year, spending is $860 in terms of the congressional outlay, down 5% year over year, but that number is a little bit misleading because of the OCO spending that was allocated to the Ukraine and Israel defense support. So when you look at it from a base number, it's something like up 1 to 2%, so pretty steady. But the big number will be the President Trump's expected budget or requested budget for fiscal 26. As I said, it's looking like something $962 billion he's seeking, so 12% above the fiscal 25 numbers. Also, that spending would reflect something like 70% increase from the trough levels. And that plan assumes some kind of supplemental or reconciliation bill that would add up another $113 billion. And just some of his objectives that they were highlighting in his proposal, reestablishing this deterrence, basically talking about China, rebuilding the military. He's got something about the warrior ethos, which I have no idea what that means, but it sounds cool. And then reform and optimization. But really the strength in titanium demand is going to come from those first two categories where you're going to see strong naval spending, Air Force and land programs back in the budget, back in view. And then, finally, when you look at kind of the momentum, looks like spending is going to surpass the $1 trillion level by fiscal 2027. So all indicators are very strong. The one cautious statement I would make is a lot of those capital dollar, a lot of that dollar is going to be allocated to new technologies, missile defense systems, this global dome. So those might be fewer or less titanium intensive type of projects. So perhaps the move toward new technologies is a negative in terms of the secular demand, but that remains to be seen. And then this is a chart showing the spending budget. You can see strong growth over the next 4 years added on to what we've already amassed in terms of the budget prior to that. And then when you look at some of the big projects in the pipeline, at least as it relates to this budget, a lot of 25 billion or something like that allocated to Global Dome. Whether or not that's a real thing, I guess we'll determine that later on. The one thing I can tell you is when I was doing the survey last week, I asked the contacts whether or not they believe this Global Dome initiative is a real thing, and it came out 22% believe it's going to come out and materialize into something. So a lot of skepticism in that spending, but within here you're also seeing submarine spending and then the B-2 bomber. And when we think about the rebuilding of the military, 65 billion going to the air programs that are out there, so nice spending there. You've got a big number, 65 billion going to sea power, a lot of investments into what you call the destroyers, 3 submarines I believe are in there, and then a lot of other smaller land sea projects, and then finally land power, a lot of investments in terms of armor and some of the vehicles out there. But when you add it up, the funding, 130 some jets and unmanned drones, all those type of aircraft are going to be purchased in fiscal 26. That would be compared to 65 last year, with the change predominantly being on the Joint Strike Fighter. So it looks like the president's penalizing Lockheed Martin for some of the cost overruns and problems that's going to be going on there. Okay, so we are also seeing some pretty good foreign defense spending initiatives. Growth is in the 10 to 12% range when you look at all global defense spending. So I guess we can say great that there's all this conflict out there and this rearmament initiative. But when you think about where this money is coming from, it's basically foreign nations reallocating a higher percentage of GDP to defense spending, right? Poland, Sweden, some of the other countries that historically have not put a lot of capital to defense spending of turning, even Japan, and that's really where the new money is coming from. Looks like there's going to be somewhere in the neighborhood of 540 to 550 total aircraft produced in this fiscal, or in 2025, and those are the countries that we believe are going to build them. And then when you think about next year, something around 575 to 600 total aircraft. So a nice strong level of demand for titanium. On top of that, you've got support from drone production. You've got this tankers. You've got all the other aircraft that are in the pipeline as well. But again, naval is going to be a big point of emphasis. Some of the programs I just kind of gave you guys an update in terms of where they're headed directionally. Feels like the Joint Strike Fighter, a little bit of questions around because of engine issues, and then they had some production issues last year. Sounds like Lockheed has probably solved most of the problems. They're expecting to deliver something around 190 jets this year, but that includes the 100 aircraft that are stored in inventory, and they're still looking to produce about 155, 160 aircraft on an annualized basis. The reason you have some sideways numbers is there is some concern about cost overruns and the inability to kind of hit production targets on the Air Force. So maybe some cutbacks there longer term. But what we're seeing is pretty good outlook for the F-15. Spitting on this or something. F-15, I think they're going to be doubling production there. The F-18 is basically going to go away in about 2 years. That's the negative. And then you've got F-16, which is also going to be increasing capacity. On the foreign side, as well as the F-47. F-47, interesting because they are starting to produce that aircraft. It is in the production pipeline. I don't believe they're expecting to deliver the first jet before 2028, maybe even longer, but you will start to see sourcing of titanium there. And then a lot of green on the European aircraft programs, the Typhoon, the Dassault, the Rafale, as well as the Saab Gripen, all moving higher in terms of production targets, given the strong demand coming from NATO countries. I guess we'll wait and see if there's any kind of negative implications in terms of sourcing, where the material will be sourced from due to all this tariff and global trade tension. But finally seeing some pretty strong numbers coming out of Europe. So when you start thinking about the model, and when I put together some of the forecasts, you've got, like I said, strong defense spending, but a lot of that allocation of capital is going to like cybersecurity, infrastructure on the nuclear side, missile systems, things that I don't expect to drive a lot of titanium demand. You will see kind of sideways movement in the tankers, larger aircraft, helicopters. It's something to keep in mind as we move forward, whether or not we're going to see way more unmanned aircraft being purchased and less emphasis on fighter jets from the president's perspective. I don't know if it helps that Elon is finally gone, but that's something to think about. You've got a strong backlog of submarines, destroyers, as I said. So we're expecting the 2026, 2027 numbers. 2027 numbers to move higher on the naval strength. And then the one thing I guess I'm concerned about is the stalled negotiations between Boeing and the workforce representing the defense factories in Missouri and Illinois. As it stands right now, it looks like there's no agreement in sight. Boeing's talking about replacement workers. Something to keep in mind is those replacement workers have to go through a security check if not being trained. So if there's no resolution with this union, it could be 6 months or longer before Boeing is even able to produce any fighters or aircraft out of those factories. And then the last thing to keep in mind, and something I'll talk about a little bit more, is this whole tariff-related inflation situation. I don't think it's worked through the markets yet in terms of the cost and margin pressure, and then what suppliers will be doing to counteract that. But all that being said, here is my military forecast. This is just titanium demand for the Western world. For 2015, I have 22 million pounds, which is about 6% growth year over year. Looking for 7.5% growth in 2026. And then I have the market somewhere around 28, 29 million pounds. So that's that 22% growth from the 2024 levels. My guess is these numbers are more likely to come down than go up because of some of the macro uncertainties and other headwinds out there, but this is kind of the starting point. So that being said, I kind of wanted to take a look at some of the issues that could affect the market from a perspective today. And one of the questions we ask is, are you, the suppliers in the aerospace channel, I should say all channels, but are you seeing margin pressure related to tariffs? And I believe it's 80% of the feedback was yes. They're getting margin pressure, and we expect them to react in some form or another, asking customers to take on some of the cost, surcharges, or slowing their procurement plans. And this 85% would compare to 50% in the second quarter. So it's really started to kick in terms of the tariffs are taking a bite in like the September is where we started to see that pick up in terms of margin pressure. But another thing to keep in mind is this other chart, which unfortunately looks exactly the same, but it says something different. This is the number of companies in our server network that are seeing cancellations of orders because of the macro uncertainty. And it's a pretty large number. 50% are seeing some type of cancellation. This is the concern we have today, and why we could see some type of recessionary environment is, it seems like President Trump, if you will, is playing a game of chicken when it comes to this tariff negotiations. And the longer he plays chicken, the only ones that are losing seem to be a lot of the companies in our network where the uncertainty drives little activity. inventories, little activity. Here's the lead time numbers. So I picked one of them. This is the estimated lead time for titanium plate mill orders, mill deliveries. You can see it's down to something like in the high teens, so way off from where we were in 2024. Not good for any kind of mill pricing perspective, but what I think is an opportunity for people that are levered to military and defense is you're going to get your material faster, less problems in terms of sourcing, and perhaps better contract stipulations. And some other things I was looking at is this is the number of companies that are, or this is the percentage of companies in the survey that are trying to hire new employees. And it's been a steady drop, and it's now down to something like 45% are looking to increase headcount. And that could be another opportunity for the military side as there's less, the fewer people looking to compete for skilled labor. And then you can also look at this number. This is the percentage of suppliers in the channel that are seeing some type of bottleneck, or their business has been slowed by some type of capacity constraint nearby, and those numbers have been steadily falling. So to the extent that aerospace and some of the other markets have slowed, it could be another opportunity for military and defense to ramp production and start hitting targets even faster. And then a couple last slides that I did last week in terms of how things are going today. This is the sentiment read for military and defense, and the score for defense was something like 8.3 or something. It was above 8, and I've never seen that number before. Could not see stronger sentiment in the military channel. Today, it's even higher than the aerospace side, as well as on the titanium side. So people very bold up still on military. And then how have things changed? This is like the outlook for in your business. How has it changed over the last 6 months? You can see it's basically no change. We're still somewhat bullish. And then there's also a small contingent of suppliers that are getting more bullish today based on what they're seeing. So nothing is changing that would actually change the outlook, at least today. And then the final thing I took a look at is just where suppliers expect demand to come from. I guess as you would probably expect, missile defense, missile systems is number one. That's where the lower, the better. It's in terms of first to last. And then you've got kind of the bread and butter titanium drivers there in the middle in terms of fighter jets and rotorcraft. And I actually made up robot fighting machines, but it did get some votes, so I put it in there in case things do actually happen. I want to be the first to predict them. So things looking good across the board. I have reports on titanium. If you guys want to see it, I'd be happy to send you guys a copy. Before you yell at me, I did forget my business card, so you'll have to email me. Hopefully it's in the system, but I'd be happy to share anything, and that's all I have. Thanks.
Thank you, Chris. Insightful and tactical as always. So the prototype on the robot fighting machines, is that next year? Yeah, got it. All right. So next we have Mr. Alex Nichol from Argus Media. Argus illuminates complex and opaque commodity markets through accurate and reliable price discovery and actionable insight. Alex, who is a non-ferrous metals reporter for Argus Media, is based in Houston, Texas. He covers price assessments, supply-demand developments, and market news for U.S. titanium scrap and ingot, as well as aluminum. He previously covered ferroalloys and other high-temp metals, including tungsten, molybdenum, and rhenium. So Alex also has got a chance to meet earlier today, and he has a great feel for the supply side, the capacity, and lead times in the industry. So please join me for the first time in welcoming Alex.
Hello, everybody. How's it going? Thank you guys so much for joining us today. I was like, kind of just want to take a look at more of, where the titanium for the defense industry is going to come from. Obviously, we take a look more at upstream markets based off what we do. We are a price reporting agency, so not being able to talk about prices up here, try to be a little bit more tactful, kind of going through the presentation a little bit. But before we begin, just obviously as you guys know, the disclaimers the group notices, I'll pause for a minute so you guys can just look through that. And then, yeah, just overview of Argus. We cover a lot of different commodities from oil and gas to emerging markets for agriculture, fertilizers, biofuels, things of that nature. But when it comes to titanium, we offer assessments covering the gamut of supply chain from mineral sands all the way to ingot. We have sponge and scrap involved in there too, and we will be launching a 6.4 feedstock price in the near future. If anyone's interested and would like to come talk to me about sizing specs afterward, I'll be all ears for sure. But taking a look, like I said, we're looking at more of the raw material side for defense. Where's the sponge coming from? Where's the scrap coming from? What does the ingot capacity numbers look like in the US? What exactly is this going to mean for the industry? So go through. I will leave this chart open up to interpretation, and just if you guys want to discuss it afterward, please feel free. But obviously, we kind of see a fall off in demand kind of starting in, late 2023, going all the way down to as recently as a couple weeks ago in terms of our market outlook. Obviously, next year, there is high hope that there will be a rebound in scrap demand and scrap need. I will say sentiment keeps getting pushed to the right. Obviously last year it was talked about, okay, third quarter, fourth quarter, 2025, we're going to see, uptick in intake. That got pushed out to fourth quarter, got pushed out to first quarter, second quarter. Now we're looking at the second half of the year for what people think, the suppliers think in the supply chain about what the demand picture will look like in terms of recovery. Obviously, because the U.S. is reliant on imports, I was like, we're going to see an influx of shipments from overseas for it to meet that grade scrap requirement. But obviously, this is very contingent on what we're seeing from the commercial aero side, from other end markets. A lot of destocking going on, as a lot of my colleagues have said up here in earlier sessions, and Chris today. Supply chain bottlenecks are obviously another factor that could impact in terms of the recovery that the suppliers are hoping for. So looking at the supply chain, looking at the new, melting capacity that's coming online, obviously this year, next year, ATI, Perryman, TiMet, they've all installed new furnaces that are in different stages of ramping up. TiMet obviously is a little bit further, needs a little bit more time to get, Ravenswood up and going. But based off the numbers we've been able to come up with, we're looking at adding about nearly 31,000 metric tons of ingot capacity in the U.S. once everything's ramped up from 2019 numbers. With that, we're starting to see, a parity in terms of consumption habits, in terms of what the consumers really are looking for scrap, just based off the furnace mix. So obviously, if you're installing more, vacuum arc remelt furnaces, that lends itself to be more in line with using 6.4 solids more so than turnings. Same thing with the electron beam furnaces. You're taking the smaller form versus the heavier form of scrap that we're seeing. So suppliers are expecting there to be some more parity in terms of consumption preferences next year before things will normalize back out post 2026. Biggest reason for that is obviously, the mills have spent a lot of money into these assets, these investments. They're going to want to run their new toys, if you want to call it that. And so obviously, even if downstream demand might not be as robust as people would like to hear, obviously you guys listened to the Airbus presentation today. There's a belief among scrap processors, scrap dealers, generators, that there will be greater intake in the second half of next year as they qualify these furnaces, as they want to start testing and melting their products. And obviously, looking at the scrap imports, obviously you can tell what happened back in 2021, 2022. 2025, we were starting to see the effects of the FAA imposed production cap. Obviously, there was less material being taken in, but we've seen a little bit of a recovery kind of the past couple months. Big anecdotally speaking with people in the market, a lot of that had to do with, nickel-based scrap. Obviously, with Annex 2 originally, it was banned, or not banned, but it was tariffed, coming into the U.S. And so a lot of processors and dealers were starting to see influx of titanium shipments because that's what suppliers overseas were willing to provide and ship over. But with that said, depending on who you speak with in the industry, scrap imports account for about anywhere from 50 to 70% of domestic consumption needs. So obviously there's going to be a big push to get more metal from overseas, and we're going to probably see it from other locations than the usual UK, EU circular relationship we have with them in terms of we give them ferrotitanium scrap, they give us vacuum quality scrap for the most part. Okay, looking at the sponge supply. Obviously, the big news when it comes to sponge is China's capacity. We're looking at, they're sitting around a little bit north of 300,000 metric tons in terms of capacity as of 2024. Definitely dwarfs Japan, Kazakhstan, Saudi Arabia all put together, including Russia as well. And so with that, there is some concern, people in the market saying they don't necessarily see Chinese sponge entering into Western defense applications for the most part. There's a little bit mixed, belief among suppliers for that. Essentially, though, here's the thing: if the mills need it, it will happen. And in terms of qualifications, it's kind of the prevailing thought across the supply chain. Now, China's supply already dwarfs the rest of the world. And now they're looking at adding about 130,000 metric tons post-2025 on new expansion projects, which is just going to extend China's oversupply for the most part. Right now, there's been obviously, just real quick looking at the ex-China sponge production, Japan, the two producers there, to increase their output nominally. Russia obviously is set to reduce their output this year based off reduced offtake OEMs in the West. And then obviously the conflict in Ukraine is obviously causing issues for ZTMC to be inactive. But with that, at the end of last year, we were starting to see more sponge being shipped into the U.S. from China. Speaking with, it seems that the consumers here were trialing it as a possible option for, there's been obviously predicted deficits in sponge supply over the next couple of years to get those qualification process started. Since the tariff situation, we've seen imports fall off completely. While the tariffs have played a role, it's been more a factor of low demand. The inventory is high across the OEMs and commercial aerospace. There's not a lot of need for new sponge suppliers at the moment, just because the mills are not necessarily operating at 100% capacity, and so the need is not there. So right now, there is an effect of tariffs on that because of the demand, but once demand picks up, tariffs really should not play that big of an impact in terms of what we're seeing in consumption from Western tie mills. Like I said, obviously, the market is split on whether Chinese supply will make its way into Western defense applications. But essentially, what will happen if Chinese sponge is able to go into commercial aerospace and other end markets, that will free up approved supply for defense applications from the traditional sponge producers. And we have an inside paper if you guys are interested in looking at that, launching our new Chinese sponge pricing. And this is just looking at the U.S. tariff timeline. Obviously, the tariff on Chinese sponge right now is 60% after Trump added the two separate 10% fentanyl tariffs. I know I'm not using necessarily the proper term for it, but that's what everyone kind of refers to it right now. And so obviously we're starting to see some impacts of that with the shipments falling off, but it remains to be seen what will happen once we get more clarity around Trump's policies and the tariff situation. Now, looking at defense, I was like, obviously, you've probably seen a lot of these numbers already today, but just kind of going over, defense initiatives are obviously going to be a driver for titanium demand. Volumes are going to be regionally limited. A big factor of that is the tie content per fighter jet program. It varies obviously by program. US-based jet programs, a little bit heavier in the titanium content than the European ones. But still, obviously, it's good news that for tie suppliers that we're starting to see greater spending among NATO nations. Obviously, the EU is looking to spend about 381 billion euros In 2025, that's about 37% increase from 2021 numbers. So obviously there's investment. The macro geopolitical situation speaks to itself in terms of, what these countries are looking for in terms of what they're building up their capabilities. When it comes to the U.S., obviously we're kind of looking more at the fighter jet programs. Plate is big for armor, for ground vehicles and naval as well. But looking at the fighter jet, just keeping with the aerospace theme, we're starting to see increased spending across most major fighter jet programs. Most of it is going toward MRO, improvements in their capabilities more so than outright production. So take the percentages with the outright numbers with a little bit of a grain of salt in terms of driving titanium demand. It's just to kind of show you how the U.S. is thinking of spending on these programs. Then obviously the F-35 is kind of the one that's bucking the trend. As Chris said, maybe Trump's knocking Lockheed Martin for the cost overruns and the challenges that they've dealt with. But still, the U.S. is forecasting that they're going to be operating around, nearly 2,500 F-35s through 2088. Obviously, hundreds are already being delivered or are delivered to military branches right now. So essentially, it's showing that there is going to be demand for titanium from the defense industry going forward. And then just for fun, we like to throw in a little look into what the tie content is per jet program. So taking, the rough percentage of estimates that we've been collecting in the industry, we can be able to net it back out to an outright volume. So you kind of get to see what the tie content is on a per pound basis. I will say, obviously, it remains to be seen what's going to happen with the 6th generation, with the F-47, how much tie is going to be involved in that production, mostly because of the use of composites may limit demand. But in terms of that, like I said, I just wanted to say, thank you guys for having me speak. As a shameless plug, we have a booth at, booth 717, far left side. Come check us out. And, if you have any questions about my presentation, feel free to come ask me about it. Thank you guys so much.
Thank you, Alex, for all that insight. So we do have a few minutes. Do we have any questions? We can open the floor up and pass the mic around for any of these gentlemen. No? I know, Monday at 4:15, I get it. All right, well, thank you guys so much. And Chris and Alex, we appreciate you being here. Everyone have a good rest of your day. Thank you.